everyone. Thanks for tuning in to episode 16 of Takeaways. My name is Patrick Searcy. I'm Director of Marketing for ALN Apartment Data, and I'm joined by the star of the show, Jordan Brooks, who's our Senior Market Analyst. Jordan, how you doing?
I'm doing great, Patrick. How about you?
I'm doing really well. I know you've had a really busy year, especially the second half of the year. It's winding down, almost Thanksgiving. You have a little bit of a break coming up here then?
I do, yes. No travel, no speaking events for the rest of the year, at least as of now. We'll see if that holds, but for now, a little bit of a slowdown.
That's great. That's great. Well, I know that we're going to be looking forward to 2022 and what you have for your speaking engagements and the rest of the articles for this year. But let's talk about this article. The article we're talking about is average lease-up time has decreased after years of increase. It's a great article. Let's start at the national level here and talk to us a little bit about the trends that have happened there.
Yeah, so really at the national level, going back the last 4 or 5 years or so, as new supply has really ramped up and the construction pipeline has been especially active, we've seen lease-up times sort of in an associated move up. And each year hasn't necessarily been some huge jump. From 2018 to 2019, there wasn't a massive increase, but there was a little bit of an increase. And then, of course, from 2019 to 2020, we saw a big jump. And so for this year, for properties that have stabilized, the decrease wasn't huge. It was about 3% compared to what we saw in 2020. So, we're not talking necessarily about some dramatic decrease, but it was just the first year in recent years where we saw any downward move. And that came at a time when, in terms of unit count, we've seen significantly more properties lease up this year compared to previous years. So, we've got just through October over 425,000 units in properties that have reached stabilization in 2021, which was more than any of the recent complete years. So we've seen a higher volume and also quicker lease up times for that higher volume.
Well, below those national numbers, what stood out to you while you were kind of researching through all of this for the article?
Well, one interesting thing was we typically see the larger markets have a little bit of a longer lease up duration, and that's that makes sense that they're typically seeing a lot of new supply. There's more competition for those lease ups, and that held true this year. The tier one markets, as we call them, ALN, the 33 largest multifamily markets in the country, continue to have the highest average lease up duration. But across the board, when we're looking at market tier, which for us, we have 4 market tiers from the largest markets to the smallest, all 4 have decreased in 2021. And really the biggest decrease that we saw was in the tier 2 area. So sort of the smaller primary markets and then the larger secondary markets would be kind of how to think about those. And there we saw about a 7% decrease at the average. And then tier 3, kind of the tertiary markets, they did decrease, but very, very slightly. It was essentially a sideways move. And there we really saw a large uptick in new supply this year, and properties in a lease up phase. So again, that has something to do with that number. But again, across the board, we saw decreases at the market tier level.
You mentioned throughout the article some specific markets, and they're kind of like at either end of the spectrum there. And did anything major kind of stand out to you from those at the market level?
Yes, there were a couple of things that stood out. For one, we looked in the newsletter both at a regional view based on NAA regions and a market view. And regionally, the Northeast really kind of stood out in terms of having a higher average lease up time. And in particular, Massachusetts, New Jersey, and New York were really driving that result. And New York is an area where every year they're top 3 or 4 in new supply. So that's an area with a lot of lease up units, which of course contributes to that longer average lease up time. The average for properties to stabilize this year has been 16 months compared to the U.S. average of a little bit below 14. So from a regional perspective, that region kind of stuck out. At the market level, if you look at the top 25 markets for lowest average lease up time, about half of those 25 markets were in 3 states: Georgia, Florida, and Texas. And that's not to say that in Texas in particular, it was all good news, because actually, just like New York with a lot of new units, Austin and Houston, which have had a lot of new development in recent years, were actually below the national average in terms of, they have a higher than average lease up time. So it wasn't all roses in Texas, but in terms of the top 25 markets, again, about half of those were Florida, Georgia, and Texas.
As you finished writing the article, what stood out to you? What were your final takeaways from this month's newsletter article?
Well, I think, just like a lot of topics that you could and we have written about, whether it's absorption, rent growth, the complete retreat of lease concessions, this is just sort of another data point showing how strong the multifamily rebound has been this year from all of the craziness of 2020. We have a situation, like I said, where more units have reached stabilization in 10 months this year than in any of the previous 5 years for total years. And yet, even in that environment, the average lease up time for those properties has been lower than in those years. And so again, it just kind of paints this picture of generational demand. And in particular, that's a positive reflection of the demand in the Class A space, because of course, the majority of new units are going to be coming in that Class A space. And so I think that's got to be kind of the main takeaway. Is just, once again, this year has been amazing in terms of multifamily demand in particular, and we're seeing that play out across multiple metrics.
Gotcha. What's next for you? We've kind of hit on this already, but what's next for you?
Yeah, so as we talked about, I do have a little bit of a slowdown so far. We'll see if that holds. You never know, it might crop up in the last minute. But for now, I'm going to be spending a little bit more time with the blog. So we're going to have some great content, going up there. Viewers of this can check that out at alndata.com/blog. And then as we turn to 2022, I'll be hitting the road, and we'll see where that takes us.
Well, we look forward to the content you've got coming out. And if you want to get notified for all of that, you can follow us on Twitter at ALN APT Data, or you can follow us on Facebook or LinkedIn. Don't forget, as about right now, we've got that notification and subscribe button. Click those. That way you're always notified of our new content that we put out on YouTube. Jordan, thanks again so much for taking time to talk with us today. Happy Thanksgiving, and I look forward to talking with you next month.
Happy Thanksgiving to you as well. See you next month.